Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One of the great moments for Bloomberg surveillance is when research notes are accompanied by the bow tie. Yes, I'm in the background, hidden in the blurry view, but far more important is Klaus the Beast has a bow tie on, celebrating the 9th birthday of Michael Darda's dog, Klaus. On the vineyard, Michael Darda joins this morning. Is Klaus ensconced in a bow tie today, Michael?
Well, actually, Tom, Klaus is under the covers. It's a little chilly this morning, so he has not arisen just yet.
It's a little chilly in Washington. How does the international relations moment fold into the markets, or is it a distraction?
You know, that's a good one, Tom. I hate to be curt here, but I think unless you're really looking at a big disruption of commerce, these geopolitical events don't tend to have large lasting effects on markets. So at least if we're talking about the U.S. equity market, I don't think you're going to see much more than a fleeting impact here, unless there's some kind of big unexpected breakthrough, and then maybe you'll get a little bit more than that. But my guess is that it won't be material and long lasting.
Michael, it's about a year ago that the Fed began cutting rates. Some folks are saying, all right, let's do a redux here this year. How do you expect our Fed to react in September? Maybe guide for the remainder of the year.
Well, the markets are fully priced now for a 25 basis point rate reduction in September. And over the course of the next year, markets are expecting the Fed policy rate to drop a little more than 100 basis points. But my view here is that a go slow approach is appropriate. When I look at tracking estimates for the third quarter, it looks like we're running pretty close to 5% nominal. So Tom Keene figure there. A 5% nominal growth handle, frankly, is not indicative of an economy that needs emergency rate cuts. And if you think about where we were last fall when the Fed kicked off the easing with a 50 basis point reduction, we were coming off peak policy rates, 100 basis points higher than they are today. And the unemployment rate had been moving up, triggering, certain recession alarm bells. Inflation expectations were rolling over really hard. That's not happening today. So I think against the current backdrop, the Fed needs to be pretty gradual. Definitely, I think the Treasury Secretary out there saying, the Fed's 150 to 175 basis points too high. I don't know where that comes from. That looks completely off base to me.
I thank Jonathan Farrell for that interview. That was talked about, to say the least, last week. We welcome all of you across the nation on Sirius XM channel. Well, help me, Paul, 121?
Sure.
The brain goes on a Monday. Yep. Channel 121. Good morning, Sirius XM. On Apple CarPlay and Android Auto. 99.1 FM. Karen Moscow Radio in Washington, 92.9 FM in Boston. Good morning, Bloomberg 1130 on YouTube, on the Vineyard on Nantucket. Subscribe to YouTube in your office or at the beach house with Klaus. Paul?
So, Michael, it looks like the consumer is kind of hanging in there here. I mean, how do you view the consumer with all these crosswinds out there?
The consumer is hanging in there, Paul. That's good news. So right now, it looks like real consumer spending is probably running just above 2% for the third quarter. Again, that's not a picture of an economy that necessarily needs emergency policy rate reductions. And I think the reason for that is we're coming through this uncertainty fog now. We obviously got hit with a big uncertainty and confidence shock earlier in the year, but the labor market has remained fully employed. Despite the slowdown in job growth, the unemployment rate has been dead flat for the last year, 4.2%. That's fully employed based on any reading of history.
Right.
And you also have very high asset prices, right? Household net worth has been moving up with the stock market. And as long as layoffs stay low here, I think that's really the key feature, because the labor force growth has slowed with the shuttering of the border. If layoffs start shooting up, that's a different story. But those first-time claims have been low and steady.
Paul, if somebody emails in, they go, is it too early to go nerd? I said it's never too early to go nerd. We go nerd with Michael Darda. Michael, we've got a wonderful Taylor rule function on the Bloomberg, folks. It's got 1, 2, 3, 4, 5, 6, 7 plugins, and John W. Taylor's out of Stanford is classic rule. Right now, the Taylor rule, as you suggest, Michael, suggests rates where they are is fine, and Secretary Besson is wrong. Which attribute in the Taylor rule is the most Darda unknown? Is it Nehru? It's not a jacket, folks. Is it the inflation guess? Which is the variable most up to debate?
Well, Tom, we really don't know where any of those variables are going with any super precision. But one question we can ask, and I think Larry Summers mentioned this on X Twitter last night, if the Fed is dramatically above neutral for any period of time, we would know it because the economy would crater. Asset prices would implode. So if you have a 10-quarter average nominal growth rate of 5%, pretty strong real growth, and soaring risk asset prices, that is highly unlikely to be a scenario in which the Federal Reserve has short-term interest rates 150 or 175 basis points above neutral. Now, we can debate the forecasts and where the economy is growing, but if you're arguing out of one side of the mouth that this is the best economy the world's ever seen, and out of the other that we need hundreds of basis points of rate cuts to support it, I'm sorry, but that just does not compute.
Michael Darda, thanks so much. Greatly appreciate it. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Without question, our interview of the day, Angela Stent was with us a few days ago. Her book, Putin's World is Definitive. This is a day of NATO and the President of the United States. Angela, I don't want to turn it into a history lesson, but coming out of 1949, we pieced together this thing, NATO, and it's morphed over the years. And then we decided somewhere in the vicinity of 07, 08 that we wanted NATO to expand east. Did we make the right decision in America that NATO should reach out to Eastern Europe before Mr. Putin exploded, and part of that is the Ukraine war?
I think we did. Good morning, everyone. Yeah, I mean, if you think about it, after the Soviet Union collapsed, you had the countries of the former Warsaw Pact, Eastern Europe, and they were kind of in limbo. Many of these countries had been invaded either by the Russian Empire, by the Soviet Union. They didn't really have any place. And so it was the right thing to do was to include them in NATO to make sure that, there were territorial disputes between a number of these countries, Romania and Hungary and others, to make sure that they were democratic. So this was not a mistake. In hindsight, we can say if Ukraine had been a member of NATO, Russia wouldn't have invaded it.
What do you want? I can't imagine the history today, Angela Stent, back to when you and I were trying to figure out the height of the Berlin Wall. What do we want to do here so we don't have a domino theory in Europe? Mr. Stubbs of Finland is really worried about that, isn't he?
He is. And you noted that all of these major European leaders are going to accompany President Zelensky today in the White House with President Trump to make sure that he doesn't just sell Ukraine short. What they want to make sure is that Russia ends this war and doesn't have designs on other former Soviet states or even on rolling back the NATO enlargement. So I would say the stakes are pretty high today in the White House, and the European leaders do not want a repeat of what happened to poor President Zelensky, that dressing down a few months ago in the Oval Office by President Trump and Vice President Vance.
So, Angela, in reality, What is a verifiable win today for Mr. Zelensky and the European leaders?
Well, a verifiable win would mean that President Trump is not going to try and persuade Ukraine that has to give up territory that Russia doesn't even control. I mean, just yesterday, President Trump again said on Truth Social, it's up to Zelensky to end the war. It isn't up to Zelensky. He didn't start the war. The Russians started the war. So it's to make sure that Zelensky doesn't have to give up territory he doesn't control, and to get President Trump to agree, which we have hints on, that if there were a settlement, if the war were to end, that the U.S. would back the Europeans up in security guarantees for Ukraine to prevent Russia from waiting a few years and then attacking Ukraine again, and the U.S. agreeing to help the Europeans doing that.
And it seems like the reality is Mr. Putin has no intention of stopping the war. What's to prevent him from just dragging things on?
Yeah, that's the heart of the matter.
That's kind of it here. And he's got an American president that may allow that. Who knows?
Right. I mean, it's going to be very difficult. You know, President Trump completely reversed himself. He went into the discussions in Alaska saying there had to be a ceasefire first, and then they could discuss the conditions. And now, so, I mean, the thing that the Europeans and Ukraine have to do today is to persuade President Trump that that's just not viable, and that they have to push for a ceasefire first.
Across the nation and around the world, Angela Stent with us this morning from Brookings Institution. Angela, the FT, I mean, they don't sugarcoat it. This is an editorial from the Financial Times of London. Donald Trump's Alaska summit with Vladimir Putin was an embarrassing failure. Worse, it was a terrible mistake. And what I find interesting, Angela, let me quote this exactly. For the Europeans, it means pushing back more assertively against Trump's alignment with Putin while appealing to congressional Republicans and members of the administration who surely have grave misgivings about the Alaska fiasco. I mean, Angela, that's an incredible to-do list for Europe. Who will lead that assertive pushback of NATO? Does it come out of Brussels, or is it every nation for themselves?
Well, I think the Secretary General of NATO, Mark Rutte, the former Netherlands Prime Minister, he seems to be a leader in this. I mean, we have the other leaders there, the British Prime Minister, French President, German Chancellor, the Italian Prime Minister. They'll all try and push. But I suspect that Mark Rutte will be the leader here. But it's a huge, tall order for them because they're very concerned that the U.S. will just kind of abandon Ukraine, and that it's not only Ukraine that's going to be threatened by Russia then, but the whole of Europe.
Angela, is there any role here, any voice here for the U.S. Congress?
Well, there is. I mean, and we know that a number of the U.S. senators, including Republicans, were very concerned about what happened in Alaska and about President Trump really ceding Putin what Putin wanted. So there is. The question is, will the Congress stand up and you know, try and persuade the Trump administration, particularly the Republicans in Congress, that they have to really put pressure on President Putin to end this?
Angela, thank you so much. Dr. Sten is at Brookings Institution. Her book is definitive. It is Putin War. Look for her essays at Brookings. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
And let's get into a first Jackson Hole brief here. We get to Wednesday, traveling out there. Lisa Bramowitz and myself will be with you Friday with Michael McKee leading all our coverage in Jackson Hole. A first brief with RBC Capital Markets, U.S. rate strategies, Blake Gwinn as well. Will Powell move the bond market price up, price down?
Well, it's hard to tell. I mean, the piece that I put out, the preview, I called it Not Your 2024 Jackson Hole. And I think looking back at last year, we had a very, very clear message from Powell. I mean, he was could not have been more obvious that they were going to cut. Now, the 50, obviously, we didn't know they were going 50 yet, but made it very clear that they were going to act at that next meeting. But things were so much easier back then. You had unemployment rate on a long uptrend. Remember triggering the Somme rule, everybody was kind of freaked out about the labor market. At the same time, inflation was coming down very steadily, very aggressively. So he was in a much better position last year to deliver a clear message. I don't think he has that. The data is really pulling them in two directions this time.
So what should we look for? I mean, other than sitting at the $1 million cowboy bar? I mean, we're going to be listening to Chairman Powell on Friday. What should we be listening for?
So I think one thing we might get is he might try to clip that tail of a 50 basis point cut. So we've heard Daly kind of saying, that's not the right move now. Okay. We need to take it a little bit more gradually. So I think he may be willing to do that. But as far as very clearly signaling a 0 or 25, it's just very hard for them to do, especially when you have this, one more round of NFP, one more round of CPI kind of hanging out there, because the last thing they want to do is very clearly set up a cut. Right. And then we get to the next data, labor bounces and inflation is hot.
You guys have a vector of disinflation led by Ian Lingdon. You guys are world class at BMO Capital Markets, at RBC Capital Markets, the whole thing. All the Canadian strategists just seem to be on a vector of disinflation. Is your call there at risk where we don't get lower yields?
No. So, we actually have inflation continuing to go up. I think we probably subscribe to the same theme that the Fed does, that this is going to be somewhat, transitory, if you will. But I think what's becoming clear is it's not going to be transitory in a clear way. It's going to leak into services. It's going to be in categories that you don't expect. It's going to happen over timelines.
So are you modeling a Fed rate cut?
We do, but not until December. And markets right now, we're still pricing over 2 cuts, and that's actually come off a lot. Last week, there was a period we were actually pricing in some probability of a 50 basis point cut in September. That's actually come back a bit, but we have them pausing.
Like Jim Bianco last week. Yeah. This is just absolutely fascinating.
If I put myself in Fed Chairman Jay Powell's shoes, I would feel pressured to cut. Do you think he feels pressured to cut, whether it's political pressure, market pressure? I don't know.
That's honestly the best case that I can draw for cutting in September mostly runs through these non-fundamental factors. Like if I just sit down and look at the data, a lot of the kind of freak out we've had over labor data since those NFP revisions, I think is a little bit overdone. A lot of those don't really look cyclical. They're education, they're government. So I think the labor situation looks okay. Right. Meanwhile, you've got some hot inflation prints that are a little bit worrying. Musalam, from the Fed said it best, I think. He said, we're missing on inflation now. We're not missing on labor. So I think if I was just looking at the data, I wouldn't see a case to cut. All of the case to cut really comes through these tangential things. It's the political pressures, the fact that the markets are already pricing in, when we've seen the Fed not really want to surprise markets.
If we get an RBC Capital Markets inflation, do we risk a negative real wage? I don't think that's in the zeitgeist yet.
Yeah, I'd have to look at how that really interacts with the wages. I don't think it's really going to pass through as much to wage pressure. A lot of that's going to depend on what's happening on the labor side of it. Now, I will say on the labor side, I think one thing that's interesting with these NFPs, with the payrolls, and this is part of the reason Powell is saying you got to focus on the unemployment rate, not the payrolls. He said that at the last press conference. Yeah. You really can't tell what payrolls mean right now. Because of the shifts we have in immigration, because of retirements going on, you could actually, this is an extreme scenario, and I don't know that this is the case, but you could actually have a scenario where we have 0 or negative payrolls, but labor markets are actually getting tighter because we're losing people out of those jobs and companies have to replace them. So you could end up in a scenario like that where labor markets are getting tighter because of these lost jobs and wage pressure is actually going up.
10-year government bond is sitting here at 4.30%. Where do you think we're going to end the year?
It's funny. We're very close to our year-end targets right here. Okay. Yeah, we I think we're probably going to remain range bound. I think even if we're right, and we do see that December start to the cut, I think people kind of near term probably price out. There's a little bit to price out at the front end, but I think the back end, 10s, 30s, those remain relatively well pegged. I think most of the volatility is going to come in the 5-year, 2-year, 5-year sector.
Within Paul Sweeney's world, do you clip the coupon? Or do you have risk to total return in fixed income?
I think the trade right now, because I do not have a strong directional view on rates at these levels, things look pretty fair. I think the right way to think about things is something like a 2s10s flattener, where you are picking up positive carry. It's less because I think 2s10s is going to flatten massively, but you are earning positive carry to be in that trade, and you have a risk that we price out some of those cuts at the front end.
Is that too much jargon for Monday?
Sorry about that.
What in God's name is a 2-cent flattener?
2s10s, so basically being long the 10-year sector, short the 2-year sector. So you want the yields at the front end to go higher, yields in the back end to go lower. But if that trade doesn't move, if it doesn't actually,
that's opposite of consensus right now.
It's a bit opposite of the consensus. Most people want to be in the steepener, but that costs you money. You're bleeding away those coupons you mentioned about. You're bleeding away carry to be in that trade. It costs you money to be in that trade.
Oh. Lisa Bromwich, she's the only one who understands this stuff as far as I know. She tells me to look at the 2-10s, and it is, we have a steepener of about, 55 basis points. What does that tell me?
We're kind of at the top end of the range of that 2s10s. If you look at where it's been kind of trading, we've steepened, flattened. We've been kind of, moving about in this range. We're at the top end of that range now, which is just another reason I kind of like that flattener, because I do think we probably pulled back down into that range.
So on Friday, he's going to speak. And as you say, we have other economic data coming. What is the dynamic if the world is disappointed and we get a Blake Gwinn call?
That's more on the front end. That's more on the 2-year part of that trade, because I think what happens if he does clip that tail of a 50, markets are going to take that as a bit hawkish. I think if he comes out and very clearly says.
Do you talk to Amy Wu Silverman? Or is it
I talk to Lori and Amy all the time.
My deepest sympathies. What does it do to their world if we get a Blake Gwinn delay in rate cuts?
They would not like that. I cannot imagine equities are going to be taking that well. I'm sure I'm going to be answering many phone calls from Lori and Amy on that. But yeah, I mean, equities have been very sensitive to what's going on in the rate space recently. That's been true the last year. And I think you can just tell by the nature of the questions you get from the equity side that a lot of people want these rate cuts to happen. So that would definitely come as a disappointment, I think.
Let me pause you right now. Across the nation, good morning on your commute. Good morning on YouTube as well. It's our new digital distribution. You can watch us on YouTube, subscribe to Bloomberg Podcast. The President of the United States, active on Twitter this morning, and this germane to this afternoon. A big day at the White House. We have never had so many European leaders here at one time. A great honor for America. 3 exclamation points. Let's see what the results will be. 3 question marks. President DJT. That from President Trump here moments ago. Blake Gwinn, thank you so much with RBC Capital Markets. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Joining us now, and I'm sorry to say, folks, this is the most important conversation of the day. I'm sorry, Angela Stent. Kona Hake with us on what has happened to coffee. Kona Hake is head of commodities at ED&F Man. She is absolutely encyclopedic on the softs. So coffee is drought, but is it really just about demand, and particularly, Kona, our demand of fancy coffee?
Okay, so it's supply and demand. It's not just demand. And right now, we're in a situation where we've come from 2 or 3 years of consecutive deficits, very much led by the supply side. So we've had consecutive bad weather events in countries like Brazil and Vietnam, which are the major producers. And on top of that, as you mentioned on the demand side, demand is pretty inelastic. You're not really seeing, despite almost record prices, you're not really seeing that much of a destruction in demand. And it's because consumption of coffee is pretty inelastic. It's a small price to pay compared to other luxurious items in this inflationary environment. And I feel like that's something that they're willing to pay a few more dollars for, irrespective of the fact that, we've got a supply side deficit.
So talk to us about the supply of coffee. I've seen the map on the walls of some Starbucks around the world. I kind of get a sense that certain parts of the globe is kind of where you grow up, but all those parts of the globe seem like they're subject to wild weather. Talk to us about the supply.
Yeah, it is. It's pretty much grown in all the tropical countries, which as we know now, it's increasingly susceptible to climate change and therefore extreme weather events, whether it's more floods or more droughts or the severity of either of those happening at a more frequent level. So inevitably, it means that perfect conditions for prolonged periods is just not something that we can continue to expect. So while normally high prices normally lead to greater husbandry and greater farmer planting and make more acreage, unfortunately, you're still at the vulnerability of the weather. And this is where we see a bit of a issue, because most recently, the reason why coffee prices have been rising again after having dipped quite a bit is because there was a bit of a frost event in Brazil.
Conan, in honor of you, I did log coffee back 50 years, 50 years. You can do this on the Bloomberg Professional service. You do logarithmic coffee. And I ran, we're out 5 standard deviations, which is like a medical chart. We've come back, we're now 3.2 standard deviations. Do you see a permanence, Kona, to this? Because of our inelastic demand, I have to have my cup of Sanka or I can't get through the day.
No. As you said, we've already come down from 5 log to 3. At some point, we will come down even more, but not necessarily back to where we were in the 2018s when the green coffee was about 150 cents per pound. Today, we're about 3 times that, 300 cents per pound, with good reason. Now, yes, demand is inelastic, but we are expecting, not necessarily this year has been a bad crop in terms of Brazil, but next year we should see a bigger Brazil crop, and that should allow prices to come off a little bit more. So we're about a year away from that big crop now, and obviously anything can happen, but for now, assuming we get that massive supply response, which we're expecting in about 9 months' time, then hopefully that can bring the supply demand a little bit more into balance, and then that should allow prices to come off a little bit. But obviously, we've got for the US consumer, though, you've got the tariffs. Brazil has got a 50% import tariff imposed on it, and coffee is not exempt. So, unfortunately, even if the world sees low green coffee prices, the US consumer may have to suck that 50% import tariff still.
Get one more question here, Paul, because you're at Starbucks 8 times a week.
Well, yeah. All right. So Tom's concerned about coffee, as many people are. John Tucker and I are concerned about energy, oil. WTI crude oil, it's $62 a barrel here. How low can this thing go?
Buy again. So OPEC Plus are ramping up. Non-OPEC is ramping up. We have a potential reduction in geopolitical risk premium with this, if these post-Alaska, if the Washington talks with Zelensky come up to some kind of ceasefire deal, that could potentially lead to a massive exporter of a massive region where oil is exported coming into more normal situation. And, we could see a post-sanction era where things going slightly back to normal and trade flows resume back to prior to 22. So I think those are the fundamentals, and a little bit of a reduced geopolitical risk premium, which is all causing downward pressure on prices.
Kona, thank you so much for the brief. We do bigger, 60,000 feet stuff. I just want to know what a cup of coffee is going to be. Kona Hake is absolutely definitive at ED&F Man here on the soft commodities. Really appreciate it.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.